welcome to this webinar on retirement planning for doctors. Really appreciate you taking the time off to attend this session, and I hope there is some takeaway for you at the end of this session. Our objective while financial planning for anyone, be it a doctor or anyone else from any other profession, is a wide gamut of activities that are involved. In this particular webinar, our focus has been restricted to retirement planning only, with the objective of how to make it as simple as possible, as easy as possible. So we would just be touching upon these particular aspects. Okay, we will start the session. Just a second. Yeah. So the first step to any financial plan or retirement planning or managing your money is you should be able to answer the why. In my over 2 decades of experience as a financial advisor and being in this domain, if you don't get the why correctly, it becomes you don't tend to have the discipline to do it and to get on to the entire process. So specifically for doctors, why should you be putting in the time and effort to involve in such an exercise? So this is based on our understanding of interacting with clients who are currently doctors, as well as a general awareness and understanding of this particular profession. So if anybody has any input, I would be glad if you could add it in our chat box. So first is occupational hazards. When compared to all the professions today are very stressful. There's a lot of time management issues, stress issues. But for probably doctors, it's a little more because there's a constant need to upskill yourself constantly, the long working hours, erratic working hours. So there are both personal and professional hazards. On a personal front, probably your health takes a toll, your long working hours. Professionally, there could be a lot of challenges in terms of meeting the patient's requirements. So it is very difficult for somebody like you to take the time out to manage your money. Okay, so the first thing is because of how your career is shaped up, at least in other professions, many of them do get a Saturday and a Sunday as a holiday, but in your particular case, it's all the more difficult. At least in the early stages of your career. So it is important that there is initially at least you set some time aside to decide why you want to do this. Second, any financial plan, any planning for any of your financial goals, it is very important to have a structured approach. It brings in a sense of discipline, clarity, and direction to the entire process. You know why you're doing what you're doing. Third and most important, the one thing that I can tell after being for such a long time in this industry is any corpus creation for a goal as important as retirement. We keep saying nobody is going to give us loan during our retirement years. We will get loans for anything else, car purchase, house purchase, children's education, but for our retirement, nobody is going to give us a loan. Retirement corpus creates time to be built. The one thing that after 2 decades I can say is investing is a simple journey. Is simple, but it takes time. You need patience. You need to understand. You need to be in the process. So the earlier you start, the better. So understand and it's the easiest goal to start with, because all of us will retire at some point in time. Doctors I hear don't retire ever, but I'm sure there is a timeline you would like to set for yourself when you choose whether how much you want to work and how you would like to go about it. So corpus creation for any long-term goal like retirement takes many years. So that's another reason why you need to plan. What happens typically in a doctor's life is also that because the typical tendency is to you start earning a little later when compared to other professions. when you actually start planning for your retirement, there are many other goals also that come into the picture. Typically, especially for women who may get married, children come into the picture. You may land up having a house purchase. Parents are getting old. So a lot of things that could come into your journey of building a corpus for your retirement, and they tend to take a priority. So you need to have a dedicated intent to plan for your retirement and then go for any other goal. In fact, even for others, when we interact with our clients, if somebody comes to us and tells us that my children's goal is a priority, we try putting it across to them that make retirement your priority, because there will be ways as a parent, as an individual, we will not typically compromise for the children in our family in any respect, but we may compromise for our retirement. Okay. So because there are a lot of other goals that come into the picture, it is important that you have a dedicated intent to this. Inflation. Inflation is is a relatively well understood topic in today's context. Many people understand inflation. Typical now, the government has done, RBI has done a good job of managing inflation and brought it down to closer to 4 to 4.5% currently. But even if we take last year or 2 years back, or how the scenario in US, inflation has really shot up in many things. What 100 rupees that we could buy today is not going to be the case. We will get into the details of this as we proceed in the webinar. But inflation can be a big game changer, something if you do not plan for it, if you do not keep track of it, it could really affect what corpus you may need to have in the latter years. Finally, this is very important. Investing is a habit. There are only two things that, whether you come to an advisor like me or go to anybody or do it yourself, there are only two aspects of your personal nature that will help you build a good corpus and be financially free. Number one is discipline to do it. Number two is asset allocation. If you go wrong on these two, there are good enough chances that you may not be very comfortably thing. You may be earning well, but how you manage the earnings is what is going to determine how you do. So that calls for discipline. Second is where you put in your assets. So investing is a habit. It takes time, because especially because you're not from this profession, it takes time to get the grip and grasp of how it is done. So take time, put in the effort to inculcate this habit of investing and understanding how it works. Now, coming to the challenge that typically doctors face were specific to retirement planning. The first is delayed start to investing. My understanding is that typically doctors would start earning, if you're a resident doctor, senior resident doctor, around 28, 29 years. And when compared to other professional professions, maybe they would start between 23 to 26. It's a delayed start to investing. But here I would like to add one thing. Even from people from other professions typically come to us only in their mid 30s to late 30s. That's also because the general awareness that they probably need to do something more comes only around that age. When you are married, when you have kids, and when there are other responsibilities that come into the picture. So probably it's not a delayed start. I'll also explain why I'm saying this. It is maybe if you are inherently a very disciplined person, right from the day one that you start earning, you start investing, then probably it is. But even if you start this process of investing and planning for your retirement when you're close to, when you just start becoming a senior resident doctor around 28 to 30, that is great. That is good enough, I would say. Lack of time, yes, this is definitely a big issue for doctors, and we have later as part of the webinar, we have covered how you can address this particular issue, very simple ways in which your lack of time can be sorted out. Erratic income and additional investments, especially for those into private practice, every month may not be the same. It's like being an entrepreneur, where you're not sure whether this month what expectation you have as income and fees is going to come in. Plus, when you're doing a private practice, there's a constant demand for additional investments to buy equipments, machines, and such similar requirements. So this is a big challenge. This could also be an impediment to planning other goals because resources are limited. Insurance, you as doctors specifically, or doctors or any profession which is service related, it's you need to take a professional indemnity insurance, because there could be a lot of claims of negligence and issues that could crop up. Higher requirement for upskilling, delayed structured planning, and also we are given to understand when we do financial planning for things that even if you are associated with a hospital, many hospitals treat you as a consultant and you may not necessarily be getting this employee provident fund, which is a very important investment avenue, especially when you want to create a retirement corpus. This is a very important point, and probably this is only drawback I would see for doctors. So, but having said that, there are other ways in which you can compensate for it and offset it. At the later part in the session, I've mentioned very simple ways in which you don't need to be in too many products. You don't need to be in too many investment avenues. You just need to keep it simple and be disciplined about it. So these are challenges specifically to the doctor. There are other issues which we come across generally, whether you're a doctor or not doctor, is not being goal based. Like this particular session is on retirement planning, and we are saying, how do you plan to go about planning for your retirement? You need to have that specific goal in mind. I want to buy a car. I want to have a TV. I want to buy this iPhone. I want to buy a home. So until and unless you specify the goal, it's going to be very difficult. And it's not just when I say goal based, it does not mean knowing what your thing. Me wanting to retire with a 50 crore corpus is an aspiration, but me quantifying it that I want that 50 crores and saying that by 2050 I should be having 50 crores is quantifying and being goal based. So whichever goal you're planning for, financial goal, I'm restricting obviously the session is restricted only to financial goals. You will have to quantify it and you'll have to specify the timeline. Otherwise, there is no meaning, no sense to getting onto this process. Again, this is a point which you will hear me repeating like a broken record many times. Asset allocation, it's very, very important. As I mentioned just a very short while ago, there are only two points, two things that any of us, doctors, non-doctors, should remember. One is discipline, and second is asset allocation. You may do it yourself. You may come to me. You may go to any financial advisor. Please ensure that these two qualities are something that you do it correctly. What happens if you don't have asset allocation? Your investments can be very unstructured. You may get a call from a bank. The person tells you this insurance product is good, sir. You have some spare money. You may go in for it. Idle money lying in thing, you may think, okay, there will be some expenditure coming 3 months down the line, let the money be idle, it's okay. So these are small mistakes which immediately you will not see the impact, but they will have an impact in the very long run. And when I say very long run, over a 20 to 30 year time period. So make sure that your asset allocation is right, so that your investments are not very unstructured and random. I invest in a land here, I invest in a electronic gadget, I do. So it makes you a lot more conscious on where your resources are going. So as a first step, let's understand what are the steps that we need to take. I'll also show it to you with an example. It is a very simple math. There are plenty of retirement calculators available online. You can come to us, you can go to any financial advisor, or you can go to do it yourself with the help of a retirement calculator available online. Very easy process, but please do it. So the first step is you need to determine what is your monthly expense for a comfortable living. If you have children, don't include the children expenses, but if you and your spouse, what is it that you would like to, you would need basic minimum income, including maybe the one or on and off vacation, everything. What is the monthly expense that you would require to maintain your lifestyle? Second, and the most important thing while calculating any corpus, be it retirement or anything, is have a sense of a perspective on your inflation number. Currently, we are taking anything from 5% to 7% while computing the retirement corpus or any corpus for our for the normal living expenses for our clients. If you would like to be very conservative, what I would advise is you take a very high number for inflation so that even under the worst case scenario, you're prepared. But 5 to 6% kind of an inflation number that you would arrive, you need to take is fair enough. Third, decide the year in which you wish to retire. As I mentioned, if you don't quantify the number, if you don't mention the timeline, there is no point. For retirement corpus, we have to take in an assumption of a life expectancy. Typically, most advisors take about 85 years. Some this is also post discussion with the clients. They will tell us maybe take it at 70. Some tell us no, take it higher because typical life expectancy in my family is very high. It's your choice. You can take till whatever year you think you'll be happily around. And then you need to figure out after once you stop earning what rate my corpus would grow. Okay, and finally arrive at a retirement corpus. So this may seem a little complicated. I will help and show it to you over a simple Excel. So this is a person who was born in 1979. So he's 45 right now, and he needs about 75,000 today's cost to for a comfortable living for him and his wife. So when he is 55 years, his retirement age, he has specified 55 years. So one, he has given me the monthly quantum. Second, he has given me the year. Okay. So I have clarity on those two. So assuming a 5% inflation, what is 75,000 today? I did mention for those who are not aware of this concept, your 75,000 today will be 1,22,000 10 years down the line. He wants to retire when he's 55. It's going to be 1,22,000. So I mentioned the point here that inflation can be a big game changer like what we saw in US last 2-3 years. So please take this very seriously. So he would need, assuming a life expectancy of 85 years, which we normally take, assuming from 56th year to the 85th year, this particular person will need a particular requirement every year. So it's a simple math where you just take this 1,22,000 into 12 times for the first year, and then you'll have to again take in inflation. Okay, you just add up the entire corpus requirement from the 56th to the 85th year, because he will retire in 55th year and he will need money from the 56th to the 85th year. Add the total money that you would need and assume take an assumption on what rate your corpus would you think should grow. Today, our investments, depending on your risk profile, may grow anything between 7 to 10 to 12%. We normally take it at 8% because it's a safe assumption. We don't know how markets would be. We don't know how scenarios would change. 8% is a fair expectation that your money should grow at. Some may tell me that it's on the lower side, but I think it's better to be conservative here than go wrong on the corpus front. So this particular person will require about 2.78 crores to see through a comfortable living till 85 years. Coming back to the presentation, and again, reiterating this, you don't need to break your head. There are plenty of retirement calculators available today in the market. You can just go in and put in the numbers. It's a few minutes work. So once you arrive at the retirement corpus, this is another point. I'm just emphasizing on how inflation works. Inflation is at least between 3 to 6% over the last 5 years. If you see in 2022, it almost touched 7% in India. So be fair in your estimate. So this is basically how you would the career path of doctor typically works. So you may start as a resident doctor. This is somebody who is associated with a hospital. I may err a little on how the technicalities, please forgive me for that. This is based on my understanding. So when you start as a resident doctor, my assumption is the package could be anything between 5 to 9 lakhs. This is the right age when you should start planning and the accumulation phase. So there are 4 stages for building any corpus for a long-term goal like retirement. It's planning, you accumulate, then you preserve the capital, and then it's called distribution. Okay, these are the 4 different stages. So when you join as a resident doctor is when you should start planning for how do I want to go about it. You will not have clarity at that age, like young people from other professions also. Very difficult to know how your life is going to shape up. You're still fresh, you're still a lot of energy, but that's a good time to start planning on your finances. So start planning for your retirement corpus. Retirement goal, while it takes the longest time, is the easiest goal to start working towards. Okay, so start planning and start accumulating. You can start small. If you move to a registrar stage, my understanding is the package could be anything from 10 to 18 lakhs. This is a stage when you would have, assuming you started when you were a resident doctor, you can accumulate and diversify the investment avenues. This is also very important. This is a part of asset allocation, which is something which I'll be speaking about it again in little more detail. So you'll have to accumulate and diversify your investment avenues. Should not restrict to just an FD or just a mutual fund. As diversification of your investment avenues is very important because not all asset classes will perform the same way at all times. I'm also going to show you data to substantiate that. Third, you may move in as a consultant, and consultant, given that it's the longest time span, it could be at different stages. Again, within that you would be, your income improves. This is the stage when you not only accumulate, you will not only diversify, but you'll also have to keep realigning it based on your age profile. At every age, your risk profile may be one and your age may be different. So there is some matching of there should be some alignment between your risk profile as well as your age. Given your time horizon when you want to retire. Finally, assuming you become a specialist, it's a time when you're probably at a stage in life when you have the financial freedom. You want to have the financial freedom and the time freedom to do what you want to do. So this is also a time for capital preservation and distribution. You should start thinking, how do I want to now, whatever I've done till now, how do I start getting it back so that I meet my monthly expenses, retirement requirement till my life expectancy period. So very important, you start planning and then the process continues till the distribution stage. The earlier you start planning and accumulating, the higher the corpus is going to be at a later stage. This is for somebody in the private practice. Again, you need to have when you just initially set up, income streams can be very erratic. You're not sure whether every month is going to be the same. Typically, my understanding and based on what I've observed, it could be anything between 6 to 12 lakhs. This is the planning and accumulation stage. Then you're more established, your clinic is doing well, your practice is doing well, then you could move to a slightly higher slab. Again, just like a doctor associated with a hospital, you'll have to diversify your assets, and finally, you reach a realignment and capital preservation stage. So whether you're a doctor, not a doctor, private practice, or whatever it is, the 4 phases does not change. Planning, accumulation, capital preservation, and distribution will not change for anybody. But it is, I've just tried showing how specifically it could work for somebody in your field. This particular slide that I'm going to cover applies to anyone, again, doctor or non-doctor. There are few risk management. See, before you even get into your investment journey, it is very important that you're protected on the risk side, because something going wrong in this could make a lot of things turn topsy-turvy. So one needs to be very careful. What are the must-do? It is for you, it is for me, it is for anybody who's earning and who wishes to protect theirs and their family's future. The first is you must have a health cover. All of you are from that domain. Probably I don't need to elaborate too much. During COVID times, even otherwise, we have seen clients, any health emergency could really severely hamper their current finances, health insurance is very, very important. Make sure you don't compromise on this particular aspect of your money management. The earlier you take, the better. The more no claim bonuses, no more additions you would have, more benefits you would have. Later stage also, if you have not taken one, that I normally say that there is never a wrong age to take up a health cover. It is still you better to pay a high premium than not having one and paying lakhs of rupees and digging into your investments and savings. So please have a health cover, irrespective of whether your hospital provides it. In case it's a private practice, all the more why you need to have a base cover of 10 lakhs is what we normally tell people you must have. Over and above that, you can take something called a super top up. You can ask your advisor or whoever you think would be aware of this. Second is an emergency corpus. Especially for those who are starting out in their career, please have at least 6 months to 1 year as an emergency corpus. This can be put in simple mutual funds. So this is again one of the basic requirements before you start your investment journey. Third is have a life cover or a term cover. The normal rule is that you need to have a life cover or term cover under two circumstances: when you either have dependents on your income or you have loans or any other liability. Typically, many of the doctors come in with a lot of education loans still waiting to be repaid. So if irrespective, however young you are, if you have loans as one of your responsibilities, repayment of loans is one of your responsibilities, please make sure that you have a life cover so that God forbid, no, something happens, your family and other dependents do not have to suffer. This is some basic rule for across anybody, be it your profession or any other profession. So this cannot be taken. For doctors, maybe or anybody else, you can combine it with a disability rider or an accidental rider. Besides this, the other two insurance that most doctors we see also take, and it is a must, earlier good to have, is a professional indemnity in case there are unnecessary claims of negligence. It also covers legal fees and a lot of other aspects. So please make sure you take a professional indemnity insurance. I think most of the government general insurance companies provides this, as well as one or two private ones. Second is, especially if you're in a private practice, please take an insurance for your clinic, for the equipment, for the machinery. There are such policies available. So make sure you do take a property insurance. So these five things are a basic, are a must. Even if you delay your investments, it's fine. Please make sure you're covered on the risk part for these five aspects of your life. Now, finally, we'll get on to how the investing process goes. So we understood how we can arrive at the corpus of understanding. And now, before you get on to the investment journey, please understand, like everything else in life, you're unique, you're an individual, you're different. So your story may be different. Your background, you may come from a very well-to-do background, or you may have had to go through hardships to reach where you have successfully reached till this stage. So each one's story is different. So when you're starting out, be aware of that and keep that in mind before you get on to your investment journey. So the first step in an investment journey is you should know your risk profile, which is what we just showed also. You should know your risk profile. Am I somebody who wants my capital to be safe, money to be safe, and I'm okay with 7 to 9% return, or everybody else is earning 20%, I'm ready to take that risk. I'm only 30, 31, or I'm only 35. I can take that risk and wait for 2025. There is no right or wrong about it. Investments have to match what your risk profile and the time horizon. Okay. So when we say, so first understand what kind of a person I am. Am I okay with taking very high risk? Many of them come to us and say, oh, I'm okay. I'm ready to stay invested. I can be there. But a slight volatility in the market makes them pretty jittery, and they immediately call us and tell us, well, is my money safe? So understand that if there are some investment avenues like equities where you need to stay invested, it will be volatile. Not every year is going to be the same. So you should have a mix of that. This is again where asset allocation comes into play, because your risk profile will also help you decide what your asset allocation is going to be. Next most important thing, after you have understood your risk profile, you need to understand the risk profile of the different investments. You would have seen these ads very often nowadays of especially when it comes to mutual funds or insurance, as to how each investment avenue is belongs to a particular risk category. So it could be low risk or a moderately high risk or very high risk. Okay, so your risk profile should match the risk profile of that particular investment class. So if the risk and return is always a trade-off, lower the risk, lower the return, higher the risk, higher the return, no rocket science about it. So have this basic conceptual understanding. You cannot be too low risk, you cannot be a very high risk, especially for something like a retirement corpus. It has to be a balance. So understand the different investment avenues. That's very important. If you don't understand something, don't get into it. You don't need to be in all the investment avenues. That's something, again, I will end the session with. Keep it simple, but understand the risk return trade-off. FD is low risk, safe, but low return. When I say low return, today, in today's context, you're getting 7 to 8% across banks, which I think is very good. But if tomorrow interest rates start going down, that will come down. Equities can give you anything from 12 to 20%, depending on the category of mutual funds that you're in or stocks that you're in. Having said that, it's very, very high risk. I cannot assure you that the markets are going to be brilliant next year also the way it's going to be this year. So in a class like equities, risk is high, return is high, but you'll have to give it the time. So this is a broad guide to asset allocation given the different risk profiles. This is not a Bible, nothing that you need to very strictly adhere to, but a broad guideline on if you're somebody with a moderate risk moderate risk profile. You're fine with taking little risk, but you don't want too much of it. Good to be about 30% into debt. Hybrid means something which combines debt and equity, about 18%, about 50% into equities, and the balance into commodities. Commodities, when you say, it could be gold, silver, including many people deal in trade in other assets also, like copper and so on and so forth, or recently lithium. So try not exceeding more than 5% if you are a moderate risk profile, or any risk profile in commodities more than 5%. So this is a good exercise. It's a one-time exercise. This will keep changing with your age profile and stage at which you're in. Somebody who's already built that corpus, maybe it's the time for them to preserve their capital, so they can move a little from equities, come to hybrid kind of funds or kind of investments. So it's a call you need to take at every stage in life. Any financial plan, any retirement planning, it's not a static exercise. It's a dynamic one. It's something you will have to keep revisiting, maybe not every year, but at least once in 2, 3 years. So when we say that this is the broad breakup of your different categories in which you should be investing, our typical experience dealing with so many clients says that if you're able to have a return of about 7 to 9% overall, I'm not saying on any particular investment avenue. So you may be having mutual funds, you may be having an FD, you may be having your PPF, your insurance, your real estate, everything put together. If you're managing to earn between 7 to 9%, that's a good indicator that you're somewhere building a corpus. If it is between 5 and 7%, you probably need to rework. If it is below 5%, there's something fundamentally wrong in your approach and you need to watch. So invest, something I'm going to cover, invest in a financial plan, understand where you are placed and what is this number for me. That will be a great starting point for you to make it more structured in your approach to achieving any financial goal. So remember two things. One, try maintaining the allocation based on your risk profile. This is just a guide. Second, have an indicative number on what return your overall corpus, all your assets, everything, including that gold lying in your locker, that you have been buying every year. take that investment as zero, but that has a value. So everything put together, am I doing at least 7 to 9% is something you need to answer to yourself. Now, there are some mistakes. This is, I have just highlighted where I won't call it mistakes, wrong approach. In our interaction with doctors, we have seen clients, colleagues, clients, and all that. Typically, where doctors tend to go a little wrong when it comes to their asset allocation. A lot of them have a very high investment into real estate. Again, there is nothing right or wrong about anything, but I'll tell you why we are saying that. If you say that one property is important, your first house is important. From the second house, it's probably an aspiration. That plot is an aspiration or an investment. We are not against any of you going in for the second house or that additional plot as an investment, but if you're doing it for something, for instance, something like I'll be earning an additional income. I have money, I have that corporate surplus, I'll put it into a house and it will keep giving me a rental income. It is very, very important. When I've explained, we will be sharing the PPT also. Very important. Any investment avenue, whether it's a real estate, whether it's an FD, whether it's an equity, is the returns positive after you take away knock off inflation and taxes? Please answer this to yourself before you get into it. Somebody comes and tells you this insurance is really good, it's going to give you cash flows for the next 50 years, 30 years. Great, maybe a good one. Each insurance product is different, each equity product is different. But please spend a few minutes answering this. After inflation, knocking this, if it's giving me some return, after knocking off inflation and taxes, is the number still higher than zero is something. So as you can see, the rental yields across India has not crossed between maybe 5% anywhere. Typically, it's between 2.5 to 3.5% is the highest rental yield that you can expect. I get to hear that in a city like Bangalore, it's recently gone up to 4%. Even then, post-tax, if you remove tax, I'm assuming most of you are in the 30% tax bracket. Post-tax, you're earning less than 2%. Take away inflation, it's a negative yield. So before you put that huge lump sum money into buying another plot and blocking your money and your liquidity into a real estate, think, is this helping me grow my corpus? Is this helping me earn positive return? This is very, very, very important for you to have a good corpus built at the end of your thing. So before you go overboard into real estate, give these things a thought. So these are a few pointers. Please go through it. Other important thing, as I mentioned, is unnecessarily blocks your liquidity. You may be at a stage in life where you need to have that liquidity, and it is important that you also have to do for other goals. Blocking a lot of money into real estate may hamper that. The next is playing it safe. As you progress in your career, the earnings really improve for many of them. So many of them we have observed tend to keep their money idle in a savings bank account. A savings bank account, it's also taxable today beyond that particular limit. You get anything from 2.5 to 3.5%. Of course, small finance banks and other small private banks give you a much higher rate. Post-tax, there is nothing you get practically. So don't let your money remain idle. If there are a few lakhs that you have, try investing, if not anything, in a debt mutual fund where you'll at least get 6 to 7%. And even post-tax, you'll earn higher than what you're earning in a savings bank. Similarly, for an FD. FD is good. If it matches your risk profile, do it, but do it only as part of your allocation, because even in an FD, post-tax, are you getting at least more than 6%? So this particular thing is you need to understand. So don't play too safe. You need to have a balance if you really want to create a corpus keeping inflation in mind. Third thing that we have generally observed is, and this is more to do with lack of time and so lack of knowledge to invest in understanding what it is very less exposure to equities. This is changing, of course, that we are also seeing many because of a lot of awareness, media, and dissemination of information across many portals and all that. People are understanding the importance of having some money into mutual funds or stocks directly. So don't be underinvested in equities. If you want to build a corpus for a big corpus for goals like your children's education, your retirement, you need to have some allocation to equities. So make sure, if you see India over the last 20 years, this is very recent data from Funds India, gave almost 15% return in equities over the last 20 years. Tell me one other asset class which has been able to beat inflation so effectively. Going forward, this number may not be 15%, it may be only 10%. I think 10 to 12% would be a very realistic number. We are currently at about 3.5 to 4 trillion economy. Even if we touch where China is, which is about 16 trillion, and move to that completely developed economy phase, the trajectory of interest rates is only going to be downwards. Our equity returns are linked to our interest rate returns. So maybe in future we'll earn 10%. But the point is not that whether you earn 10% or 15%, the point is, are you going to be covering inflation? Okay. So many doctors we have observed make these three things of letting their money be idle or putting it into very safe investment avenues like savings bank and FD, or going overboard with real estate, or being underinvested in equity. So we have covered only specific to doctors. There are many other mistakes you can do with asset allocation, which we are not getting too much into detail. But if you have any simple question, you can ask me later. So this is one very simple rule to remember with respect to asset allocation. What return, whichever investment revenue you're putting, from that remove inflation, remove taxes, and after that, if it is still a positive number, then look at it. If it is going to be a negative kind of a number, you need to rethink, do I really want to be in this investment avenue? This is a very simple rule to remember. The second simple rule to remember is have a balance between your physical assets and your financial assets. Physical assets, land, gold, whatever it may be, is that more than 50%? It will definitely impact your overall returns. So you need to strike a right balance between a physical and a financial asset. You don't need do an investment into any physical asset if you're really sure it meets some aspirational requirement of yours, provided some other goal has been met. Then the third is tax saving, low yielding investments like an insurance or an FD or a corpus building investment with a moderate to high risk profile. Recent budget, a lot of rules have been changed, which in a way is good. While people may be cribbing that the effective long-term capital gains rate for a lot of asset classes has gone up. From a financial point of view, I can vouch for this, that now a person who's going into investing will not look at an asset as a tax saving one or a non-tax saving one. They will go more from an asset allocation point of view. So when you're planning your money, taxes does impact. I don't deny it, but don't approach any particular product class from a tax perspective. This is just data to show you why asset allocation diversification is important, because no asset class performs every year. As you can see, Nifty return over the last 20 years, there are many negative return years in which it has given negative returns. Fixed deposit returns have only been coming down over the last 20 years. These are home prices. This has been relatively more stable for between FY 2011 and 2021. They've grown at about 11%. My guess is this number should be very much higher if you take the last 2-3 years into consideration. So each asset class gives you a different rate of return. Don't lose out the scope for earning higher returns by just not being present in that and just being into one which is same. Like if you had been too much into real estate, you would have earned good returns, maybe 11 to 14%. But equities as an asset class has given you 15%. So make sure you're spread out, you're diversified your investment avenues. This is for gold. Gold, even 3 years back, if somebody had asked me from 1981 till 2021-22, average rate of return of gold was only 5%. The performance has been stellar over the last 2-3 years. There are many reasons for this. Some of them is geopolitical, because lot of wars, lot of threats to the way economies are going to perform, like COVID and all that. That was one reason why gold did well. Second, there's a general as a direction, the importance of dollar is coming down in the global economy. So there are a lot of big countries like India and China, which are increasingly purchasing a lot of gold to act as a hedge to and protection to their currency, so that they can move away from gold or move away from dollar. So there are a lot of reasons why gold has done well as an asset class, but typically don't try not going overboard in commodity. So this is more to just show you how different asset classes perform differently at different points in time. Now, finally, we'll come to the end of the session. We initially, when we started the webinar, we spoke what are the key challenges specific to a doctor, okay, in starting their financial journey or planning for their retirement corpus. So first is we get to hear it's a delayed start. So it's a very simple solution to that is start small. You don't need to have a very big corpus. If you're at it, like what I mentioned, there are only two things that will help you earn a corpus. One is your discipline, one is your asset allocation. So if you're disciplined enough, even if you start with just a simple SIP of 5,000 rupees, yielding you 10% rate of return, you manage a good corpus of 1.13 crores. What I would advise people to do is, if you cannot in initial stage, you may have your family commitments, responsibilities. There is something called step up. I'll just show that to you by way of an Excel. So you may start with just 5,000. Someday in the step up SIP, I've taken an example of 10,000. You start with simple 10,000 SIP in year one. It gives you 10%. The end of the first year, you manage about 1.25 lakhs. You just increase it by 1,000 rupees. So this 10% more. Make it 11,000 in the second year, 12,100 in the third year. By the end of the 35th year, assuming you're 30 and you're a doctor who will retire at 65, you'll manage to accumulate a corpus of 11 crores. It's a simple maths. It's in front of you. There is no manipulation or thing I'm doing. Simple 10,000 rupees, increase it by just 1,000 or 10% every year and see what magic it does to your numbers. This is simple power of compounding. Please work on, try it, do it, execute it, nothing. So whatever be, irrespective of the age or your commitments, try starting small. If you think you're starting late, that's fine, but you can start small. And second thing is you should step it up every year. Then second challenge that doctors typically say is lack of time. One thing that I would very strongly advise is go to any financial advisor or a friend who has done it. See, we don't need to reinvent the wheel. A lot of them, because of the awareness that has been created, how well mutual funds have done or how well any other asset class has done, there's a lot of awareness on most of the investment avenues today. So we don't need to reinvent the wheel. Just go to a financial advisor and take help. Once you're into the journey, you will also put in that effort to understand. The second thing I would strongly recommend and advise is, if you're starting out, however young you are, start with a financial plan. A financial plan will give you clarity on where you stand with respect to your goal achievement. It could be retirement, it could be a vacation, it could be children's education, whatever be the goal. A financial plan will put it into numbers. Numbers speak louder than anything else. Will give you, okay, in this particular goal, my goal achievement is only 10%. In this, it is 50%. In this, it is 90%. Okay, so put it into numbers. They speak for themselves. So second thing is what I would recommend is spend a little time for one-time effort for a financial plan. Third, in today's context, every investment happens online. Very few are there. Gone are those days when we needed to visit a bank or visit your advisor or visit the fund house, whatever, to process or get your investments done. Today, everything happens online. Spend a few minutes to just set it up, be it NPS, be it mutual fund, be it PPF, be it whatever investment avenues, everything happens online. So automate your investments. It's no rocket science. All of you are pretty tech savvy, is my guess. So please do that. The last is every investment today. The other evolution, I would say, that has happened, and a very good one is Every investment today can be done on a monthly basis. If you're doing an NPS also, it can be done on a monthly basis. Mutual funds can be done on a monthly basis. PPF can be done on a monthly basis. So try making your investments more from a discipline point of view also on a monthly basis. Just set it up once so that you don't have to worry about it. You will also automatically spend only the balance, and there'll be silently a corpus will be growing. So try streamline. Even stocks, even shares can be bought on a monthly basis today. So every investment avenue gives you this benefit. Utilize it, make it so everything can be automated, everything can be made it on a monthly basis to reduce your burden. Finally, I'll coming to the end of the session. You don't need to complicate it. Any financial planning, anything is about making your life simple, your investment journey simple, and at the same time arriving at your goal, which is in this case retirement goal. You don't need to have too many products. You don't need to have too many investment avenues. A simple mutual fund, a simple public provident fund, a simple NPS, even this combination is good enough. Mutual funds, try having more of equities. NPS is a hybrid product, so it gives you the scope of putting into a government security also, a corporate bond also, an equity also. A public provident fund, highly recommended. Well, it's one of the lowest yielding instrument. It tells you 7.51%, but it will probably be the only instrument besides Sukanya Samriddhi, which will be tax free. So just doing these three simple things also will help you go big corporates. Why I have not included EPF? I get to hear that many hospitals do not provide EPF to their employees because they work in the capacity of a consultant. So that's the reason. Otherwise, typically people from other professions, even if they have been at it in contributing to their employee provident fund, they manage a very good corpus at the time of their retirement, provided they don't withdraw and they don't use it for any other goal. Okay. So keep the investment avenue simple, keep your the process simple by automating it. It's just a one-time effort and you don't need to do anything else. So few takeaways. Risk management, make sure you are well protected on the insurance front, both personally in terms of a health, life cover and emergency corporate, as well as professionally. You have a property insurance and a personal indemnity insurance. You can start small, understand your risk profile and that of the investments. Fourth point, very important, your return should always be over inflation and taxes. It should be a number that is positive. However young you to have a financial plan and put down your goals. You may not have complete clarity like in life about anything, but it to have some sense of direction. Understand basic personal finance rules. If you have the time to put maybe 15 minutes a day, I'm very lucky. I consider myself lucky to be in this domain because it's constant learning. Even if you can spend 15 to 20 minutes every day just picking up one point, it will really enrich your knowledge base. Finally, especially for those who are in the distribution phase, who are in the capital preservation phase, doctors, make a will. Will is good. It's like a financial plan. Will is good at any age, but you've really worked hard all these years. Make sure that it goes to the right people in the right way in case you're not there. Making a will part of your overall investment journey is also important. So that brings us to the end of the session. Very quickly on my organization, we are headquartered in Bangalore with branches in all other key locations of our country. It's close to a 75-member team. We manage about 3,000 crores. We are fortes on the financial planning front, and we also have our in-house PMS. So if there's anybody who would like to reach us, we would be very happy to explore an opportunity to be of assistance. These are my credentials. If anyone has any doubt post this webinar or had any query and would like to also give their feedback on whether you found it useful or we could add on to it, would be very, very glad to hear from them. Yeah, thank you.